how much money should he start putting, to become a millionaire?
There's never been a period of the S&P 500 where $250 a month doesn't turn into over $1 million. Compound growth is really powerful. About every 7 years, the money will double.
I can double my money in 1 year by picking individual stock.
That mentality leads to staying broke for decades.
There are so many index funds to choose from, right? So which one should he choose?
The point is, it doesn't matter which one, just pick one and stick with it.
Almost like 90% of mutual funds can't beat the market.
But it's just survivorship bias. Mutual funds are fine, but it's a very dangerous marketing game with these market-beating funds.
I don't want to wait for 40 years to become a millionaire. How can I become a millionaire faster?
It's basically a very simple math equation.
S&P 500 versus total stock market index. Which one should I pick?
S&P 500 versus total market fund is like, instead of picking and choosing stocks, an index fund buys all the stocks. And so when I say index fund, I mean total market index fund. Rule number 1 is to live below your means. And rule number 2 is
Hello and welcome to the Compounding Project podcast, where we talk about taking small steps to become healthy, wealthy, and wise. I'm your host Satish Kajula, and this episode is all about wealth, especially index funds. Our guest today is Jeremy Schneider, who's joining us from San Diego, California. Jeremy is a self-made millionaire and the founder of the wildly popular Personal Finance Club. Through his work on YouTube, Instagram, and other social media platforms, he has built a community of over 1 million people by making complex topics incredibly simple. So get ready to learn how to become a millionaire using index funds. With that, Jeremy, welcome to the show.
What an intro. Thank you for having me.
Yeah, I hope it's all uphill from here. Let's see. All right, so I'm going to dive right in. While doing some research upon you, I found a few interesting things. And one thing that stood out to me is you graduated from college, you got an offer from Microsoft, and you even had a dinner at Bill Gates' house, but you turned down the offer. Why? Is there a backstory?
To be clear, the dinner wasn't like a recruiting dinner or something like that. It was actually, I was an intern at Microsoft for 2 summers, and they would invite the graduating interns to his house for like a barbecue. So it was like me and 50 other interns or something like that. And yeah, they gave me a full-time job offer, and I basically just didn't want to work for a big corporation. I was like 22, and the Redmond area of Seattle is very dude heavy, and I felt like working there, I was a programmer, and I feel like they just wanted you to program, all day, every day. And if you worked super duper hard or you just kind of phoned it in, it wouldn't really change your, trajectory that much. And so I was like, I'd rather start something on my own.
Got it. I mean, it's very difficult to turn on an offer. I'm assuming there must be a sign-on bonus and a nice base salary and also annual bonus and also stock options, right? But did you have something else going on? Otherwise, it's too difficult to say no, right? Because if you have, I think, nothing else going on.
I had nothing else going on. I was broke. Yeah, I was more money than I'd ever seen in my life. I guess the one other thing I did have going on was my girlfriend at the time had 1 more year of college left. And so I didn't really want to leave town, or I might have, I could have still taken the job. I could have, done long distance for 9 months or something. Because she had went out with me the previous summer. So she was already familiar with the Seattle area. But, yeah, no, I had nothing else lined up, and I literally decided to start a company. And so I Googled like how to start a company. I had no idea how to do it. Like, do you have to fill out a certain form? Am I going to be breaking the law? I had no idea. And that was my next plan.
Wow, that's good. Okay, can you talk about what happened next then?
Well, I started a company. It was kind of my last semester of college. I'd already turned out the offer, and I Googled, how to start a company. And, my first real client I was literally just trying to do anything for anyone. I was like, someone give me money. And I was a computer programmer. So I was like, I'll do computer programming. And I emailed my old landlord. I lived in a college town, and I sent him an email because he had a really bad website. It was like horrible. Like it looked like someone had like written it in Microsoft Word, clicked save as website, and uploaded it. Just not at all. And this was years ago, but still was not at all like a modern website. And so I built him an entire brand new website without asking, and I like found all his properties, and I even like took some photos and basically like did a ton of work and built in this like took this really old fashioned thing to where you could search and sort and see it on a map and yada yada yada. And I sent it to him and emailed him and was like, hey, I thought you might need a website upgrade. Like, I'm a former tenant. Like, what do you think? And he did not respond. And I was like, oh man, it probably took me like 3 or 4 days to build a site. Like, I was making no money, so it wasn't that big of a deal to like waste 3 days of work, but I at least wanted to get like a node in my face. And so then against all my better instincts, I picked up the phone and called. And this was like 2003. And so like calling people was a little bit more socially acceptable than like, now it'd probably be a text or something. And he picked up and I was like, hey, I'm Jeremy. I sent you an email about your website. Did you get it? He said, no. I was like, oh, can I send it again? And can you check? He's like, sure. And at the time I was actually like monitoring how many people were on the site from my there's a computer hosted in my like living room where I was working because there's a 1-bedroom apartment, and I could see someone connected to the website and he's the only person in the world with a link to it. I was like, oh my gosh. So for like 30 seconds he was on, and then like it went back to 0 and no one was on it. And I was like, oh, well, I tried, he looked at the website. What else am I going to do? And then the phone rang and he called me back and he's like, yeah, that looks good. We'll take it. I was like, oh, I didn't even have a price in mind yet. I didn't think we'd get here that fast. And he said, how much does it cost? I made up a number on the spot, like a flat fee and a monthly fee. And then I was in business.
Wow. I mean, that's such an inspiring story. Then, but you started a different company, assume, and then you sold that company, right? Can you talk about that journey real quick?
Yeah. So selling that one website to my old landlord, I then started selling mini websites to many landlords, trying to do the same thing. And that kind of became the company called RentLinks, which kind of turned into an apartment advertising service. So all these landlords, they're like, yeah, we kind of want a website, but we really want more leads. And so I built a service where you could send their listings, their available rental listings, out to like dozens of different apartment search websites so they could get a lot more leads coming in. And then I grew that for about 10 years, and I sold it when I was 35 for just over $5 million. And so I went from being very broke, living like, very frugally for the first decade of my, post-college adulthood, to becoming a millionaire overnight, which was very nice.
Journey is inspiring. You said you were living frugally, even though you had a startup, your own company, you were living frugally. Can you talk about your mindset when it comes to like living frugally?
Yeah. I mean, sometimes when people hear startup, they just think like you're swimming in money and, like renting high rises and things like that. We never took any venture capital. And so I was just we were bootstrapping, which means we were trying to spend less money than we made. And so, my first year in business, selling these websites to landlords, my top line sales was about $14,000. And that's like before any associated expenses, which was not many because I'm just building websites, but, maybe I took home $10,000 that year. And, even back in 2003, that's not nearly enough money to even afford the basic groceries. And so I was like, for a couple of years, I was living on credit cards. I was like using a credit card to like cover the difference in what I couldn't afford it just for my basic living expenses. I eventually was able to pay myself about $36,000 a year, which was my max take-home salary for the next 10 years. And, my mentality was just, I want to grow this business. I don't need to spend a lot of money now to impress anyone or anything. I would rather just, rent a modest apartment, drive used car, eat groceries, and, play beach volleyball, which is essentially free. And it was a good life. And I just basically never spent any money that like I didn't need to. My life is very different now that I'm like, have been rich for like almost 10 years. Now I definitely am much less frugal, and I'm married and I have 2 kids, but back then it was pretty easy to live simply.
Yeah. I mean, $36,000 living in California per year. That's, I can only imagine, how frugal it would have been. So we'll get to the actual theme of the podcast, like index funds, right? So when did you come to know about index funds, and why did you choose index funds?
I was fortunate in that when I was in high school, I got my first job working at a summer camp. And my dad basically at that point said, hey, now that you're working, part of working is investing. And he helped me open up a Roth IRA. And then we chose some mutual funds. And, we went through these like mutual fund review sites and pickers and whatever. And we chose some. And I was like, okay, cool. And then and then I continued doing that for years, like for 5 years or so, I didn't even have any money to even put it in there, but eventually I was putting a little bit. And then when I basically shook hands to sell my company, I started reading every book I could on investing, and suddenly like the picture became clear that like mutual funds are fine, but they charge, actively managed mutual funds charge higher fees and generally don't have better performance to make up for those fees. And so you can invest in something called an index fund, which has much lower fees and removes all the speculative guessing about which fund to pick and say, oh, it's good funds versus bad funds. It's like a very simple path, and it's more, conveniently is more profitable, more, beneficial for the investor.
We'll get back to the episode in just a few seconds. 94% of people who watch this channel haven't subscribed. If you're enjoying this episode, can you do me a quick favor and hit that subscribe button? It helps the channel grow and brings in even more guests so that I can provide more value to you in the future episodes. Now, back to the episode. Got it. Yeah, for somebody who's new to all these concepts, right, can you define at a high level, like what is a mutual fund and what is an index fund?
I would love to. It's my favorite thing to talk about. So at the core, the thing that you invest in is a stock, and a stock is a piece of a company. And so right now, if I Google AAPL, that is a ticker symbol for Apple. And that means if I go buy one share of AAPL, ticker symbol is like a little code that identifies that stock. If I buy one share of Apple, I think it's maybe $200 or something today, whatever it is, I would own like one billionth of Apple because they have tons of shares, right? But then I'm an owner. I own a very tiny piece of Apple, and as the company grows and yada, 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 I can collect dividends while the company profits. They pay out dividends, like a little share of the profits back to the owners. I'd get like one share worth of dividends, and I can potentially sell that stock in the future. And, investing in stocks is a great way to invest because it's, very low effort. You don't have to go and build a business or buy real estate or do really any work. You just have to basically click buy on a website, and then you can just hold these stocks and then sell them later for hopefully more money. And that's great, but it kind of begs this question, okay, which stocks do you buy? And it's a very simple question, but the answer, it turns out, is it's almost impossible to answer that because there's so many people researching the heck out of these stocks that the stock market is what's called very efficient. What that means is I know that Apple's a good company. iPhones are very popular. iTunes, the App Store, AirPods, you can research this. But the problem is, and I could come to the conclusion that because Apple has really good growth potential and all my friends use iPhones and yada, 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 that must be a good stock to buy. But the problem is everybody else knows that too. And so if I'm buying a share of stock, I'm essentially buying it from another investor who's selling it to me, and they're not going to let it go for a discount. They're going to want a premium because it's such a good company, which means the price goes basically to right where the expectations of everyone are. So what that means is the bad news, it's very hard to pick individual stocks. And when I say hard, what I really mean is like virtually impossible. You're basically down to luck. But the good news is if you just do randomly pick a stock, you're going to get kind of the fair market price. And so then, all right, if picking individual stocks is hard, what do? Enter a mutual fund. A mutual fund is where you basically hire a professional to pick a basket of stocks for you. And so instead of buying one stock at a time, I can go invest in a mutual fund. That mutual fund has a manager, and their entire full-time job is to basically buy between dozens or hundreds of stocks to put into their mutual fund. So they're doing the work of seeing is Apple good, or is Tesla good, or Nvidia, or Lululemon, or Chipotle, or FedEx, or any of these publicly traded stocks, and they do all that hard work, which sounds good because now a professional's doing it instead of an amateur. But the problem is they still have that same issue with the efficient market. They're competing against other professionals, and therefore everyone's trying to get an edge, therefore nobody gets an edge, but you're paying for that service. A mutual fund might charge about 1% per year of the assets under management. So that means if you put in $10,000, you're paying $100 per year just to manage it, which doesn't sound terrible, but over time that actually adds up and compounds. And this is called the compounding project. And so if you do that 1% per year over the course of 40 years can actually erode about 30% of your investment, right? So instead of having $1 million, you might have $700,000, which, $700,000 is nothing to shake a stick at. But if you can't lose that 300,000, that's better. So enter the index fund. And an index fund is basically a basket of stocks. In fact, it's a type of mutual fund. But this time with index funds, there's no manager. There's no active person who's picking and choosing stocks. And the fees are much lower. And so instead of having like a 1% fee, it's like a 0.1% fee in broad strokes. Some are lower, some are higher. And then therefore, your $1 million over 40 years, instead of being 700,000, would be more like 995,000 or something. Like the fee is so low that the net effect is actually really low, even over long periods of time. So that's what index fund is. Basically just, and did I not mention what that actually is? Instead of picking and choosing stocks, an index fund buys all the stocks. And so when you buy an index fund, you're buying literally every single stock in the stock market, essentially, and it's in proportion to the size. And so, right now, Microsoft or Apple might be the biggest company. So you have the most of those companies, like the second most of Tesla or Nvidia or whatever it is. And then all the way down the list, and you have a little tiny bit of every little tiny company. And so if like the next Amazon is out there, you own a little bit of it early on. And it turns out that the net effect is by buying all the stocks, you're guaranteeing yourself your fair share of all the market growth. And it turns out it's essentially like the most efficient and effective way to invest. And also it's very, very simple.
Yeah, that's good. I mean, it's simple, but not easy for sure. So we're going to dive deeper into why index funds. But I just want to take a step back and understand about this picking stocks versus picking mutual funds or in index funds, right? So I want to talk about, so whenever I bring about index funds, I'm a huge believer in index funds. And whenever I bring about index funds, the first question that I get is, I can double my money in 1 year by picking individual stocks. Like, why would I want to buy the losing stocks when what stock is going to perform well? So what are your thoughts on this? Like, why can't we just pick winning stocks?
That would be great. If I could do that, I would. The problem is that mentality leads to staying broke for decades. You hear all the time about traders who have a big win and then follow up with them 5 years later and they have less than when they started because they lost all the next trade. And picking individual stocks, like I said, is so difficult because everybody else is doing it too, that you can't just pick the good ones because everyone else is trying to pick the good ones and all that information is priced into the stock. And so what happens with traders is randomness masquerades as skill. And so you have a win because you just got lucky, like you get a good hand in poker or you hit the red on the casino and you're like, oh, I knew because I read an article on CNBC about Home Depot, and then Home Depot went up. I figured this out. I'm just going to read an article and buy the stock that's about to go up. But then the next time it doesn't work because it wasn't skill. It wasn't the research. It was just random. And then you get in this thrashing where you just keep trading, keep losing. And it turns out that when you do that over time, you end up way behind the index. And this isn't just you. This isn't just me. This isn't just like keyboard jockeys at home. Like the pros, the Wall Street experts who their whole life is shaking hands with CEOs and reading the Wall Street Journal back to front and like doing deep research on individual stocks. They study after study after study after study shows still can't consistently beat the market. They are as good as random too. And so it's basically a fool's errand to try and pick stocks, in my opinion. And I know your most recent published episode was with my dear friend Brian Frugal, who is a stock picker, but even he and I have a lot more in common than we have different, which is he's not a trader. He's not like trying to double his money every year. He would immediately admit that's crazy. He's a long-term investor. He tries to pick good stocks, but Brian and I do kind of differ where I was like, I still don't think, like I'm going to bet on the S&P 500 over a year strategy, but he's probably going to do about as good as an index because he's a buy and hold investor.
That's good. Yeah, I think I've read like a ton of books when it comes to investing, and then before I recorded, I told you like I'm a big believer in index funds. But what surprised me the most was when it comes to mutual funds, right? I mean, you mentioned like these people actually they're we are like everyday average people, but the mutual fund managers, they went to fancy schools, they got MBAs, and their whole bread and butter is to beat the market. and still they can't beat the market. I couldn't understand. So can you talk about, you mentioned like fees, right? I mean, fees, like whenever I tell this to my friends also, like when it comes to fees, like 1% fees, and then they say, low 1% isn't huge. When let's say on average, if index fund gets 10%, and if, let's say mutual fund managers, if they get like 15%, and 1% would be, not much, is what is the argument that I get. So how would you respond to that?
Yeah, I mean, on the face, that's true. If you can find a manager who can get you 15% when the market's returning 10%, then clearly that would be worth a 1% fee. Your net growth would be 14%, and great. And I hear that less these days. I used to hear that more like 10 plus years ago, where individual managers would say, hey, my job is to beat the market, therefore it's worth the fee because you're going to net do better than the market. I think that like that myth is getting more and more busted every year, just because like there's overwhelming evidence that anyone who says that is full of nonsense, right? And so what's really happening is they can't beat the market. They're going to get you so if the market returns 10%, they're going to get you about 10%. It might be some randoms in there. They might have a 12% year. They might have an 8% year, whatever. Or they might have a year where they beat by 2, lose by 2, because the market isn't very consistent either. The market's chaotic, right? But over time, they're going to probably average about the market, and then they're going to take out your fee. So you're going to net lose to the market on average by about 1% per year. And again, there's like this randomness. I might make a look, I have a big rant about financial advisors too, but a lot of times what like wealth managers will do is introduce complexity into your portfolio to basically justify their purpose. And they'll say, oh yeah, well I'm really picking sectors here, and I'm moving into cash, and I'm making reallocations, and blah 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 blah. But then you back out and you compare them to like a 3-fund portfolio of index funds, and they lose, especially net of their fees, right? And so, I'm not a big believer in it's worth the 1%, because it's not.
That's true. I think that so there is a website called Spiva Reports, where it actually compares the performance of mutual fund and when it comes to index funds. And the last time I looked at it, it said almost like 90% of mutual funds can't beat the market. Like, isn't that crazy? Like 90%, that's a huge number.
Yeah, and Jack Bogle actually looked at that. So Jack Bogle is the founder of Vanguard, like popularized the index fund, and he found the same thing. He's like, okay, I'm paraphrasing here. This isn't the exact study, but they looked at it like during the 1970s, 90% of mutual funds underperformed the index, and he said, okay, let's just buy the good ones. So then he took that 10%. So like, let's say it's 1,000 index funds, 900 of them lost the market. He's like, okay, get rid of those. Just look at the 100. So then during the 80s, just looking at the 100 winners, those guys must be good managers, right? How many of those beat the market during the 80s, during the next decade? 90% of those lost the market. So now of the original 1,000, you're down to 10. And says, okay, let's look at those during the 90s. Okay, in the 90s, of those 10, how many of those lost the market? He's like, 8 lost the market. And he literally, in his book, he's like, I'll give you the 2. The 2 are Fidelity Contrafund and the Vanguard Wellington, or whatever it is. Like, I'm not sure. I think Contrafund is one. But he's like, are those 2 the brilliant managers? Or if you flip 1,000 coins, 50 times, are you going to have 2 coins that got 10 heads in a row or whatever? Like, yeah, are those more likely to get heads, or is that just pure survivorship bias because you're only looking at the winners, right? And so the whole mutual fund industry is very guilty of this, where they basically will go make, dozens or 100 or 1,000 mutual funds, 90% lose the market. Then in their marketing during the next decade, they're like, hey, look, our 3 mutual funds beat the market over the last 10 years. And the novice investors like, oh wow, those beat the market. They must be the good ones. But it's just survivorship bias. You're cherry picking the ones that just happen to beat the market and brushing under the rug, or removing or folding or deleting all those mutual funds that underperformed. Going forward, which is what we care about, they're no more likely than random to beat the market. And so it's a very dangerous marketing game with these market-beating funds.
Exactly. Like, whenever it comes to even stocks also, like my friends keep bringing this, good stock. Let's say like Apple. If somebody invested in Apple probably like 20 years ago, or in Amazon 10 years ago, they would have been like multimillionaires now, right? So it's easy to look at the past data and then make the predictions, but it's very hard for us to look at what's the next Amazon, like what's the next Apple, right? So we don't know it. So instead, I think you famously you keep repeating this quote from Jack Bogle, don't buy the needle, just buy the haystack, right? I mean, can you talk about that?
Right. So the S&P 500 is the list of 500 biggest companies or representative companies in the US stock market. And when you look at that over a decade, most of those companies underperform the average. And the reason is there's just like a few companies that are these huge standout companies that do really well, right? And so, maybe over a 10-year period, the S&P 500 averages 10% per year. Most of those companies maybe are only returning 3 or 4%. But the difference between 3 and 4% and 10% is massive when you compound that over time. And so why is it 10%? Because a few companies returned like 25% every year. But the problem is you don't know which ones those are ahead of time. Like it's easy looking backwards, like, oh, of course Amazon, of course Apple, but like we didn't think that 20 years ago, right? And starting now, like if you look at the 10 biggest, like you go back to the year 2000, and you look at the 10 biggest companies in the US, there are names like AT&T, ExxonMobil, IBM. And back then you'd be like, yeah, why don't you just buy AT&T, ExxonMobil, and IBM? Those are, of course, going to be the best companies. Oil and technology is the future. But like, it turns out not that oil and not that technology. It was different companies. Amazon, which no one had ever heard of, like NVIDIA, which didn't even exist yet, whatever it is. And so he's saying, hey, those companies are buried somewhere like in the S&P 500, like maybe it's number 472, that a company you've never heard of. But to try to go find that company and buy that one that's 25% ahead of time is virtually impossible. So he's like, don't look for the needle in the haystack. Don't look for that one company. Just buy all 500 and guarantee yourself the 10% because it's going to be much more likely to give you the full market returns.
Yeah, in terms of, let's say, so now we have the case for index funds. So, individual stocks may not be good for, an average investor, individual stocks, right? And also mutual funds may not be good because of the high fees. And also data shows that they constantly underperform the market, right? So now we have the case for index funds. So for, let's say, an example of somebody who just graduated, let's say he has probably 50,000 in student loan debt and probably 5,000 in credit card debt, and he just got a job, maybe making $75,000 in the US, right? So how can he has the knowledge like that he needs to invest in index funds. So how can he start building his financial future?
I'm a simple guy. I like to break it down pretty simply, and in my opinion, there's a few things. I always talk about my 2 rules of building wealth. Rule number 1 is to live below your means. And rule number 2 is invest early and often. And you kind of do it in that order too. And living below your means, by definition, means not being in debt. If you have debt, you've lived beyond your means. And, we can get into the details of the student loan epidemic in America, where we're basically saddling 17-year-olds with this decision that's going to impact the rest of their life. But that sucks to have $50,000 in debt and make $75,000 a year. But a lot of people make $50,000 a year or $40,000 a year or $36,000 a year like I did. And so you might say, hey, I'm going to live like I'm making $50,000 a year. And for 36 months, from the age of 22 to 25 or something, I'm going to just be a frugal dude. I'm going to be playing beach volleyball on the beach and, drinking water or whatever it is. And then your debt's gone. And you were basically, to be doing that, you're basically throwing $1,000 to $2,000 a month at this debt. If you can then transition that $1,000 to $2,000 to investing, which is rule number 2, invest early and often, then you go from basically being in debt, potentially for your whole life, trying to pay off this $50,000 because that compounds over time if you don't pay it off quickly, to now investing $1,000 a month, and you'll easily be a multi-millionaire, and retire early and be extraordinarily wealthy just by the investing. And so, but what I just said is really simple. It's like spend less, get rid of your debt, take those debt payments that no longer exist, put them in investing, you're rich. That's what it is. But what happens in the ground reality is people are like, hey man, we're going to the bar this weekend, like, let's buy a round of shots. And you buy a round of shots and it's like $75. And you're like, oh, and then you're like, well, now I'm really tired because I've been drinking last night. I'm just going to DoorDash and that's $60. And then you're like, oh man, my friend just got a car. I'm going to get a car that's now $700 a month. And then like yada, yada, yada. Now you're back in more debt or whatever. And so it's like so easy just to not do the frugality part. But like anything, that's a trained effort. You have to like learn how to do it, be really consistent. And so you had a great phrase earlier. It's simple. It's really simple. I just said in about 2 sentences, like spend less than you make, invest. That's very simple, but it's not easy because every single day of your life, the capitalistic, materialistic nature of our universe is trying to just suck money out of you. And I feel it every day. My wife and I share a credit card now, and every day I see a little ding of a little DoorDash text alert showing up in my credit card. And, we can afford it. And like that, part of life also is spending, not just dying with a bunch of money in your bank account. So, we're making decisions for us. But yeah, in your example of the person who decided to say, hey man, like go hard early because or else that's going to follow you for decades.
Okay, that's a good advice. One question that I have is, let's say if company offers 401k and then there's free let's say 5% match, would he still, because for me, like, that's free money, right? Can he still do that 5% contribution and then tackle debt with the remaining payments, or what's your suggestion there?
In my opinion, yes, you should definitely do the match first. So a match is basically when your company is saying, hey, as part of your compensation, we're going to give you even more money, but only if you put some of your paycheck into your 401k. We live in this bizarre world where your retirement is tied to your company and your ability to get tax breaks depends on who you work for. Like, I can talk about why maybe the laws of our government aren't the best for investing. But in that scenario, if you said, if you have a match, I would definitely do it first. Because even if you do the worst possible thing on earth, which is like immediately cash out your 401k, pay the tax, pay the penalty, with a match, you still have more than you started with. And so, yeah, put in your 5%, put in the match. And then beyond that, the next step is go crush the debt, in my opinion.
Got it. Yeah, that's perfect advice right there. So let's say this person has he has been doing 5% when it comes to a 401k match, and 3 years down the line he has no credit card and he's, let's say, 28 years old. Now, like, how can he become a millionaire?
So now, yeah, you go from that paying down the debt phase to investing phase. And what you do is you basically open up an investment account. In the US, there are some tax advantage accounts. And, people get really caught up in these. There's like ones like 401k, like you mentioned, Roth IRA, HSA, TSP, 529 for kids' college. But all of those accounts are just fancy names for one type of thing, which is a investment bank account. And so just like you can open up a checking account, you can go open up an investment account called a brokerage account. And a brokerage account just basically means if you go to your local bank or credit union and you ask to buy an ETF or an index fund, they're going to say, I don't know what you're talking about. You can only put cash in this bank, or you can buy cash products like a CD or something. So you need to go to a different type of business called a brokerage. In the US, some of the big ones are Vanguard, Fidelity, and Schwab. And then you click open an account and you have a brokerage account. And the default type of brokerage account is a regular old taxable brokerage account, just like your savings account is a taxable savings account, by the way. And then you deposit money and then you buy an index fund, and by typing in the ticker symbol. It's really, you can go look up YouTube videos, or I've got videos. They're sort of pretty easy to find out how to do this. Once, before you've ever done it, it feels very terrifying. But once you do, it's like opening up a Venmo account or something. It's pretty simple. And that's it. Past that simple nature of it, then you can start considering tax advantage accounts. Like a Roth IRA is a great one for most people, where the benefit of a Roth IRA is it's a special name for a special type of investment account where you put money in, you buy an investment inside of it, then any future growth forever is never taxed ever again. Whereas in a regular taxable brokerage account, the growth is taxed. So for example, if you put in $10,000 into a brokerage account and it grows to $100,000, the government will say, hey, you made $90,000. You owe us capital gains tax, which is when you sell, you owe capital gains tax on that $90,000. In a Roth IRA, and you would get to keep all $100,000. So that's why you would use those tax advantage accounts. But, the more I do this, the years and years and years that go on, the more I come to the conclusion that getting these little intricate details right, even as far as like tax advantage versus not, has a lot less to do with overall success than getting the big things right, which is staying out of debt and investing. And, I talked about that capital gains tax example, but there's ways to avoid that capital gains tax. Like if you put every single penny to your name in a regular old brokerage account, you'd be in a great situation. In fact, most of my money is in a regular old brokerage account. That's okay, right? So don't let this like fear of getting these little tiny details right, like which index fund do I buy? Is it Roth or traditional, like Roth IRA versus 401k? Just put money in and invest it. That's what matters.
Yeah, I think I heard this phrase, people major on minor things, and then instead, they should be measuring the minor things, right?
Nice.
Or yeah, that's a good phrase there. Where, even because so I want this to be advice to be simple and also actionable, right? I mean, so when it comes to index funds, there are so many index funds. I'm a big believer in Vanguard. I like the company and also like the mission behind the company because, we are the shareholders of the company. So I like the mission behind the company. But, lately I've seen a stat where there's so much money that's moving from mutual funds to index funds. And also there are so many index funds to choose from, right? So which one should you choose? Let's keep it very actionable and simple for somebody who's just a beginner who wants to start.
I actually did a little analysis on this. I took like the 10 or 15 most popular US stock market index funds and looked at them over a 10-year period and charted them together and said, okay, and some of them tracked 3,000 companies, like a total market fund. Some of them tracked 500 companies, like an S&P 500 index fund. Some were in between, like 1,500. Some were mutual funds. Some were ETFs. Vanguard, Schwab, Fidelity, iShares. Every single different factor you could differentiate these index funds on. I looked at all of them. And when you charted them together, it looks like a single line. They're so tight, you almost can't tell there's multiple things being charted. And the lesson there is like, it doesn't matter. The whole point of, they're all buying all the stocks, right? So if you buy the Vanguard 500 fund, that's going to own Microsoft, Amazon, Nvidia, Tesla. If you buy the Schwab Total Market ETF, that's going to buy Amazon, Microsoft, Nvidia. It's like, it owns the same stuff, right? Except for like little tiny details at the bottom, right? And so the point is, it doesn't matter which one, just pick one and stick with it. And if anything you should be focusing on, it should be minimizing your fees. And there's one little tricky thing with fees is that if you go to Vanguard and you buy a Fidelity mutual fund, then you get charged a fee. You get charged like $20 per transaction. And the same is true in the inverse. And so basically, if you're buying the mutual fund version of index funds, this gets, I feel like I spend 9% of my life apologizing on behalf of the financial services industry for how complicated it is. But, basically when you're buying the mutual fund version of index funds, you want to match the fund to the brokerage. So buy Vanguard funds inside of Vanguard, buy Fidelity funds inside of Fidelity. The one caveat to that is that doesn't matter with ETFs because now basically in the US, all ETFs trade free on all major platforms. And so you can go open a Fidelity account and buy Vanguard ETFs if you want. And sorry about the complexity.
Yeah. No, that makes total sense. One question I have when it comes to index funds is index funds are actually, there are also index funds based on the sector also. There is like, technology index fund. There's also like pharmaceutical index fund, right? Commodity index fund. And so when you're referring to index funds, what exactly are you referring to? And what are your thoughts when it comes to this, segment index funds?
So I like to picture all the stocks in the world as a pie. I think pumpkin pie in my head, but I guess it could be apple. The problem with apple is it's a little bit more crumbly and maybe you can make less exacting cuts. So I'm picturing pumpkin. And there is a million ways you can slice a pie. You can cut it in half. You can cut it in little wedges. You can cut it in a grid. You can cut it in triangles. And the financial services will gladly sell any one of those insanely sliced, you can get the technology sector, you can get value funds, you can get large cap, you can get small cap, you can get international, you can get emerging markets, you can get, every single possible slice is in there. And inside of those slices, there's an index. So there might be a emerging markets technology index. There might be a North America pharmaceutical index. And so technically those are index funds, but I don't sector pick. because I'm not trying to guess which piece of the pie, just like in the haystack metaphor, I'm not trying to find the correct slice. I'm buying the whole pie. And so when I say index fund, I mean total market index fund. And in fact, Vanguard has a total, and the world is evolving, and the U.S. kind of was leading the world in terms of technological advances in finance. And so I think we were kind of the first to have index funds. And so the first index fund was a U.S. company index fund, but then they became what we call non-U.S. or international index funds. And now Vanguard says, okay, why are we keeping track of this silly border that's around our country? Let's just have a global market index fund. And so there's an ETF called VT, or there's a mutual fund called VTWAX. And they basically give you the entire pumpkin pie. That's it. No slices, no complexity. You own every single stock. And if someone came to me and said, Jeremy, my entire portfolio is the ETF VT, and I have a plan to introduce bonds in the bond fund BND as I age, is that a good portfolio? I would say that's the best goddamn portfolio I've ever seen. I can't think of a better portfolio than that. And I think any derivation from that portfolio is introducing speculation. It's introducing guessing. Someone just say, I don't know when this airs, but just say there's Iran bombing going on and uncertainty in the Middle East. And so people ask me, Jeremy, why aren't you buying the military index because it's up 30% this year? And I was like, well, if I knew that at the beginning of the year, I would have, but you don't ask me that at the beginning of the year, were you? You're asking that question too late. And now as soon as peace is declared or whatever, that's going to drop 30%, and you're chasing past performance. And so I don't slice pick, I don't sector pick, I don't large cap, small cap pick. I just buy the whole pumpkin pie.
So I have seen the world index for some reason. I was looking at the performance, and then I'm like I said, I'm begin to like VTSX, like Vanguard and stuff. So when it comes to, we were talking about S&P 500, and you're talking about also total stock market index, right? There has been a whole Reddit community just between these two, like S&P 500 versus total stock market index. And I've spent a ton of time when I first started my journey as to which one should I pick. And can you answer that? Like, what would you recommend?
When you say total stock market, do you mean total U.S. stock market or total world stock market?
Oh yeah, total U.S. stock market, VTSX versus S&P 500, just within the U.S.
My answer is it doesn't matter. Like one of my favorite posts I made is there's a clip from Family Guy where it's Jafar from Aladdin for whatever reason taking an eye exam test, and it's saying like A or B. It's like A maybe, B maybe, and this like S&P 500 versus total market fund is like, it just don't matter at all. Like for sure you can look at a certain 10-year period and be like, oh, the S&P outperformed here, or the total market outperformed there. But like fast forward 40 years, it don't matter. It do not matter. We don't know which one's going to be better. They're going to be very, very close. Doesn't matter which one's going to be better. Like that ain't your problem. That ain't anybody's problem. That's like missing. It's like, yeah, the total minutia quote you just gave. It's focusing on the wrong thing under the microscope. If you just put in $5 more and skipped one latte, I know it's not popular to say, but you skip one latte and put in $5 more, in either one, you'd be better off than wasting your brain power picking between them.
Powerful. Yeah, that's powerful. I was looking at some data, and then even like whenever people come up with some numbers, they pick a specific time period. Let's say a 13-year period, and they look at they want to show that some fund outperform the other fund. That's why whenever they come with these random numbers, right? 13-year period, 21-year period. I'm like that's just cherry picking, right? I mean it's.
And the problem with all those periods is that they're in the past. The period we care about is the one in the future, and you inherently don't know what's going to happen in the future. Of course, we can learn lessons from the past. We know that the stock market generates positive returns because the companies within it are profiting and have to grow and yada, yada, yada. But, we don't know which one's going to outperform going forward. And so don't waste your mental energy on it. Go work one more hour of overtime and put that money in, and you'll be better off.
Got it. Yeah. So let's get to the math actually. So I told you that the title of this podcast, how to become a index fund millionaire. So let's get to the math. For somebody, for the hypothetical person that we created, right, at age 25. So how much money should he start putting, to become a millionaire, maybe let's say by age 65?
The answer is any amount of money. A lot of times people ask, like, how much do I need to invest? And, most US-based brokerages these days have no minimums. And so you can open up a Fidelity account, go buy a Vanguard ETF inside a Fidelity account for no fee, and you can put $5 in it. Is $5 going to change your life? The money won't, but the experience might, because once you see what's happening with your $5, like you might log in the next day and you might be like, oh, it's $4.99. Then you might log in the next day and be like, oh, it's $5.02. And then you might log in the next year and be like, oh, it's $5.25. And if you're going years and years and years with just $5, you're not going to see much. But what happens is about every 7 years, the money will double. So that $5 you put in becomes $10 7 years from now, and then it becomes 20, and then becomes 40, then becomes 80, then becomes 160, 320, 640. Eventually you're going to die. But the power of that compound growth is really powerful. And if you're not just putting $5, but you're putting in like $5 a day or something, then instead of becoming $1,000 in retirement, it becomes millions and millions of dollars early into retirement. And so you can Google, compound growth calculator and figure out for yourself how much is the right amount. If you put in $500 a month, for example, over 40 years, it turns into about $3 million. There's never been a period of the S&P 500 where $250 a month doesn't turn into over $1 million. Like the worst ever 40-year period was like 1.2 million. The average was like 2 million, and the best was like 3 million or something. And so, and the critics always say, "Whoa, what's $1 million going to be worth?" Well, I'm like, well, you don't have $1 million today. Like, no one, you don't even have $100,000 today, right? $1 million would be worth a lot more than zero. And if you want $2 million, then double it, right? Because every time if you put twice as much in, you're going to end up with twice as much. And so, in a world where most people don't even have enough to retire, they can't retire comfortably, even with Social Security. Poo-pooing $1 million 40 years from now, I think is silly. $1 million is going to be a lot of money still. And also, as time goes on and you see traction, like in that $5 example I said, once you see traction, then you're like, okay, now I get it. Now I'm going to start putting in $50 a month. And like, now, I got a little bit of raise. I'm going to crank it up to $75 a month. And so, starting today and making a 40-year projection and putting your fingers in your ears and closing your eyes and saying, this is what it's going to be for 40 years. That's not how life happens. How life happens is you start to see traction and you start to get more ambitious and you get raises and your income goes up and inflation goes up, so the payments go up, yada, yada, yada. You end up with even more than you were planning on.
Got it. I think the first, Charlie Munger said it, the first $100,000 is the hardest. So initially, it takes a ton of energy actually to start that and also like to commit to it. But, it's like a snowball effect, right? Once you have that money in place, the money keeps growing, and then the money that earns money also keeps growing, right? So one thing you mentioned, so $250 a month, you can become a millionaire in 40 years. So which is like $250 a month is $3,000 per year. Mm-hmm. Over a 40-year period, that's actually $120,000.
Yep.
And you end up with $1 million portfolio. So your contributions are basically 10% of the portfolio.
And that was the worst it's ever performed. On average, it's more like 2 million. So it's more like 5%. Yeah. So, but yeah, it just shows the massive growth of the S&P 500.
So can you talk about the underlying principle? Like, where is that 95% of the money coming from?
It comes from the growth of companies, right? And so, in order for modern society to exist, sometimes people say like, well, what if it all goes to zero? Isn't it risky? Like, yeah, why does it have to go up? In order for modern society to exist, and when I say modern society, I mean, there are companies that make the world go round. We're not growing our own food and defending our land with, bows and arrows. We're depending on a modern economy, supply chains and, production, farming, and technology, and transportation, and shipping, and all this world. In order for that to exist, those companies have to be profitable. If those companies aren't profitable, they will go out of business, and then we will no longer be in a modern economy or in a modern world. And I don't know if we're going to always be in a modern world. Like, we might go back to the Stone Age. Nobody knows the future. But if we do go back to the Stone Age, Your bank CD ain't worth anything either. Your crypto ain't worth anything either. Your gold standard ain't worth anything either. Like what's worth something is like canned goods and gunpowder and a well in your land or whatever. And so, as long as we continue to exist in a modern world, these companies have to profit. And as long as they're profiting, the owners are going to collect that profit, right? I feel like a lot of people tell themselves this like false duality. They say, oh, corporate America is so greedy. They're always profiting. The rich are getting richer. But they're like, but the stock market's risky. That's a rigged game. I'm like, no, the stock market is that other thing. And like, they can't both be true, because when I go buy my one share of Apple for $200, now I'm one of those fat cat owners of this company that's due the same profit as the other owners out there. And so, that's where the growth comes from. And so over the course of 40 years, the companies profit and they grow and they innovate and they also pay dividends. And you take those dividends, that's your share of the profit that's paid out back to you. And then you reinvest those as just a little checkbox on your website that says reinvest dividends. When you get those dividends, you buy more, and that creates this compound growth effect, which turns your initial 5% principal investment into the $2 million that over time.
Yeah, the first time I saw this, I almost felt it too good to be true. I actually opened a Excel sheet and did the math, and then it made sense because but if people ignore that 5%, actually that 5% is why the 95% exists, right? If there is no 5%, that 95% wouldn't exist. So we can't underestimate it. Even though they're small amounts, we can't underestimate them.
No, totally. I got a question the other day. Someone started investing like $2,000 a month, like a year ago or something like that. And they said, Jeremy, my investments aren't working. I only have, $27,000. I said, you saved 24,000 and now you have 27,000, which means, and you weren't even, all that 24,000 was invested a year ago is periodic over the year. So you've gotten probably about a 20% return this year. Early on, like it is working, but early on it feels slow because most of your wealth is from the contributions early on. And you can actually chart this and see, like, if you look at the chart early on, most of the money just came from what you put in. But over time, that becomes less and less true. And then this like snowball effect happens where the growth turns into more growth. And so that person who like felt like it wasn't working, I only made $3,000 this year. You're only on year one. On year 40, it gets crazy, right? And, and some people say, oh, I don't want to wait 40 years. I'm like, that's true. But, in year 10, it gets crazy. Year 20 gets crazy. And also, by the way, a year ago, you had zero. Now you have $27,000. Like, that's not working. Obviously, a lot of it was just savings, but like, that's great. Like, that's the principle. Live below your means, invest, and eventually the compound growth is going to take off.
That's true. I think it's the social media and also the news channels, which is making us feel that, we're not enough, right? We see all these stories of, millionaires, people becoming millionaires overnight, and also, all these people having lavish lifestyle versus like comparing to us. And then, we look at our portfolio and then, the compounding just like you said, it feels like we're not making any progress in the initial years, but it's all that patience and that'll just drive like compounding goes wild once you give that time. So one question when it comes to the example that you mentioned is like 40 years. People say, okay, I don't want to wait for 40 years to become a millionaire. How can I become a millionaire faster? Is there a way we can do that?
Yeah, I don't recommend waiting 40 years. I didn't. I retired at 36, and it's basically a very simple math equation. It's the proportion of your income that you save. If you save 0% of your income and you invest 0%, you essentially can never stop working. You will have to work forever because once your income goes away, you're not going to be able to afford to eat. You'll never be able to replace that income. Social Security exists. You might get a little bit, but it's not going to replace your income. It's going to just maybe, help you from staying off the streets, maybe. If you invest 5% of your income and spend 95%, that forever becomes like 50 years. And so you're like, okay, I can work from 25 to 75. And then when I'm 75, then I'll finally be able to replace my income by saving 5%. Every single time you're saving more of your income, that time period shrinks. If you save 50%, for example, that becomes about 12 years. And so if you are an ambitious young person at 22 years old and you say, hey, I got a job for $80,000. I got a great job out of college, $80,000. I'm going to live on $40,000. When you're 34, you can literally never ever work again. That assumes you're living on the same amount, right? It's not like you can start living like a millionaire when you're 34, but that also assumes you weren't getting a raise during that time, and it assumes a bunch of stuff that work, in your advantage too. And so a lot of people are like, well, I didn't start at 22. It's like, well, if you're 40 and you have zero saved, you can start now. And then at 52, by the way, 52 is still pretty darn young. It's a heck of a lot better than 75, right? And so, but the problem is people want some like magical shortcut. They're like, oh, I want it to happen fast. I don't want to do the hard work. I don't want to save money. I was like, okay, well, that's not going to happen. And that's going to be broke. You're going to be broke forever. These like, every once in a while, there's like a GameStop thing that happens where it's like, oh, this guy bought GameStop or he bought this crypto or whatever, and, or bought a lottery ticket. I'm like, yeah, some people get super duper lucky. Not repeatable. You can try, but if you're a lotto picker, go take a sample of 100 people who are trying to win the lottery and see how their lives are going. Probably not great. Take a sample of people who are living 30% below their means and investing 30% per month. They're probably living pretty darn well.
That's a powerful advice. I posted on my Instagram story that I'll be interviewing you, and I got a bunch of questions. Of course, we can't go through all of it, but I picked the top 3. So the first one is when it comes to index funds, right? So they have a question when it comes to index funds versus ETFs. So which one should we choose, and what is optimal for somebody who wants to invest for the next 20, 30 years and not worry about investments?
Broad strokes, doesn't matter. One's not going to make you more rich than the other. Also, as time goes on, they're getting more and more similar. If you asked me this like 4 years ago, I'd say, well, ETFs aren't super convenient because you have to buy them in full shares. You have to buy them, there's no sort of automated recurring investments. And the brokerage companies have basically fixed that. And so now you can buy ETFs in partial shares, like pay dollars instead of shares, and you can set up automated recurring investments. Now the difference between them is like very, very minute. Like the main one is ETFs trade intraday. Like you can buy and sell an ETF anytime you want during the open market. Mutual funds trade once a day at the close of market. That sounds like it would give the edge to ETFs. But I kind of like the fact that you can't day trade mutual funds because it kind of forces you into this long-term mindset, right? Sometimes people are like, messages me at like 12:42 p.m. Oh, Jeremy, the market's doing something. Like, should I buy now or wait an hour? And I'm like, dude, like, you should be taking a nap and letting your automatic investments hit on the 15th of every month or whatever it is, because that's how it's going to make you the most rich. This like, the market's up 1%, down 1%. When should I get in? That's the kind of mentality that's going to like leave you with less. And so for that reason, I kind of like the mutual fund version of index funds, where it's like you set up recurring investments, you set up your dollar amount, just let it ride. It's like you sleep easy. The ETFs are just have a little bit of the, I want to day trade built into them. But that said, like if you're buying ETFs like you're trading a mutual fund, then it's going to give you the same result.
Got it. Yeah. At the end of the day, it doesn't matter. The numbers are, almost the same. So yeah, the second one, this is an interesting one. I don't know who asked this, but yeah, this question is regarding your strategy, right? So you became a millionaire by selling your own startup and investing that money in index funds. But your advice is basically for somebody, to do automatic investments every month into index funds and then become a millionaire. So why is there a disconnect there?
Sometimes people like try to get me on this, like they're like, oh, you didn't even do it. And I'm like, how I know I started a company sold? Because I talk about it all the time. I do both. And I'm a massive fan of entrepreneurship. I absolutely think people should be doing that. But you do both, right? Just like I did. And so are you going to sell your company for $5 million? I don't know. Like a lot of people sell their company for a whole heck of a lot more. $5 million in modern tech standards is like a pretty small pittance. But also there's a whole lot of people who don't sell a company at all, like probably most, right? And so the the most sure path to become a millionaire for sure is investing early and often. But like, we could have another hour and a half podcast, and I would love to talk about starting companies. I'm wearing the t-shirt of my new company I'm starting called Nectarine, which is flat fee financial advice, because I love starting companies. I love changing the world. And I think it's a really good way to take your own future in your own hands. Like the exact reason I turned down that Microsoft job offer. And so it's not really that I'm not recommending starting a company. Like I am, but the recommendation is do both.
Yes. But also it's very hard to replicate, let's say for somebody to give that advice, right? Start a company and then, it's like there's so much that goes into it, right? The market, like even the timing as to when you start the company and, the market situation. There's so much stuff. It's very hard to replicate versus like index fund strategy. There's like
totally
12 years. Yeah.
Yeah. An index fund, I was like, in about 30 seconds of a video, I can be like, click here, click here, click here. That's all you need to do for the rest of your life. That's index fund investing. Starting a company, it's like, okay, branding, marketing, sales, technology, hiring, SEO, leadership. And every one of these words I just said is, you could write books on optimizing for that. And so it's definitely like harder to like, make a little square infographic, start a company, do these two things, I mean, people do that, but it's nonsense.
Got it. I'm despite all that, success is not guaranteed, right? I mean, we have so much data that, startups, they go, maybe 90% of startups, they go bankrupt after 1 year something like that. So it's very hard to replicate.
And not everyone wants that either. It's like I also ran track in college, and people could say, why are you talking about index funds instead of like running? I was like, well, like not everyone wants to be a runner, I like running. I recommend it. Go for it. And so for your teacher who is making, it depends where you're in California, it might be more, but you're making $50,000 or $80,000 a year or whatever it is. Me giving SEO advice on how to optimize your tech company's search results like isn't very valuable, but I'm like, you can absolutely buy an index fund.
True. Yep. So the third listener question is when it comes to taxes, right? So his question is, are there any tax saving hacks for people who are on W-2? Any unknown tax saving hacks?
Everyone always wants a hack, and like almost all the stuff I see is nonsense. The big hacks are you can contribute to a 401k to reduce your taxable income. Although even doing that isn't really optimal for most people. It's usually better to contribute to a Roth 401k, which doesn't reduce your taxable income this year, but reduces your taxes on all of your future growth. I don't know. I'm not really a tax hack guy. I just, another tax hack is that wealth creation is taxed at a lower rate than income. He said I'm a W-2 guy. Welcome to the U.S., but W-2 taxes are much higher than capital gains taxes. Capital gains taxes start at 0% and kind of peak at either 15 or 20%, whereas W-2 income peaks at 39% plus your state taxes, right? And so, the hack is invest, get your investments making money. Once your money's making money, not working, you're taxed lower than working. I don't actually necessarily agree with that. I think it should at least be equal. I don't know why not working is better than working. I feel like we should be incentivizing people to work, not work. But yeah, I don't, I can't sit here and be like, oh, put your kid on, start an LLC, put your kid on payroll, blah, blah. Like almost all that stuff you see is nonsense. It's just, there's not these huge hacks out there. Get a CPA, they'll tell you, or use TurboTax, they'll find any like eligible tax breaks that you have, and beyond that, follow the 2 rules.
Got it. Yeah. So we are getting towards the end of the podcast, and then there are 2 questions that I ask all my guests. I call them the Hotseat Questions. So the first one is regarding action. So compounding project is all about taking that first step of action for compounding to kick in. So what one small step would you recommend people take right after listening to this episode?
My advice for the first step is to create a net worth spreadsheet. And I think most people, if you ask them on the street what their credit score is, they'll often know. If you ask them what their net worth is, they have no idea. And of those 2, I'd say credit score is almost an irrelevant number in your life, or should be. And net worth is your entire financial picture. And to create a net worth spreadsheet, you just open up Google Sheets or Excel, and then on the top, every single row, you put one of your assets. Checking account, how much? Savings account, how much? 401k, how much? House, what it's worth today. Car, what it's worth today. All your major assets, not like your little stuff like your clothes, even your jewelry and stuff. Like, don't worry about that. And then below that, you put all your debts. Mortgage, what's your balance? Credit card balance. And below that, you list all of your debts. So credit card debt, how much you owe. The balance on your mortgage, how much you owe. And so you have the value of the house above, you have the value of your debt below, and then you add up all those numbers, and the resulting number is your net worth. If you don't know that number, then you're kind of flying blind. It's like playing a football game and not knowing the score. Like, you need to know the score to know if you should be kicking a field goal or going for two or whatever. And knowing that your net worth is like the number one financial metric in your life to make improvements upon, right? And so I'm a big believer in that the numbers that are watched improve. If you don't even know what your net worth is, how are you going to improve it? But once you know what it is and the features that go into it, you're like, okay, less debt and more assets makes a better net worth. Then you might be making better decisions like, ooh, I'm going to go buy a car. Should I buy a $40,000 car or a $20,000 car? Because one of those is going to improve my net worth and one of them is going to hurt my net worth. So that's my advice. Number one thing, and doing this probably takes 30 minutes to go look up all the account info, whatever, and then you know that number and you can work from it going forward. That's huge.
Love that advice. I mean, there are also some apps that do that, right? I use Mint or Credit Karma, but there are also other apps that to track your net worth. Do you recommend that?
I use YNAB to track my net worth, but I also have the spreadsheet. I think apps can be a bit of a cop-out, because you didn't do it with your hands and see what went into it. With like Mint, you connect all the, Mint's dead, but you connect all your accounts, it shows you some charts. You're like, all right, I don't know. I don't really feel very empowered by this. But to do it by your hands takes 30 minutes. So I like doing it by hand. And then if you're an aficionado like you are, and you also want to use an app, huge proponent. But I think there's something nice about having an actual spreadsheet that's your record that you put from your mind onto paper or, onto spreadsheet. And then you could track from there with apps, there's always this underlying, where'd this number come from? Is this actually accurate, or is it just a pie chart that some programmer cooked up? Who knows?
Makes sense. Yeah, that's good. The second one is regarding books. So books are an integral part of the compounding project journey. So what 3 books would you recommend in 3 areas of life? 1 book on health, 1 book on wealth, and 1 book on wisdom or self-help.
All right. So for health, I actually chose, this is a little bit of an inside personal in my life, but I was single. I had girlfriends, but I was unmarried until I was 43. I got married at 43. And I read a book around 40 or 41 or something called How Not to Die Alone by Logan Ury. And I think it's really good, but it's kind of a depressing title. And it wasn't really about settling, but I think it did a really good job of putting into perspective. And now I'm married and I have 2 kids. And so look at that. It worked. That's for health, because I think marriage is health. My wife makes me go to the doctor, so I'm healthier. Number 2, wealth. I like A Random Walk Down Wall Street. I just see so much, and it's by Burn Malkiel. And I see so much nonsense out there in the world about day trading and technical analysis and stock picking and systems and yada, yada, yada. And this book just goes systematically through all this other stuff. And it makes a really, really compelling case for index funds, because all this other stuff you see is just straight up nonsense. And then the third one, which is wisdom. I chose another money one because it's a wisdom money one, but that's why I know The Psychology of Money by Morgan Housel. If the Random Walk Down Wall Street is the very technical, this is why you should be investing in index funds. The psychology of money is more how do you decide what's right for you? What's reasonable? How should you think about this? And I think both of those sides of your brain are important with money, because it's not just about the spreadsheet. A lot, if not most of money, is about why we're spending, what we're going to spend money on, those types of things, which the psychology of money talks about.
Yeah, the psychology of money keeps coming a lot on this podcast. I should probably next time ask a question and not include that book.
Oh, really? I haven't listened to all that.
Yeah, but
I listened to Brian's.
He
didn't suggest it. Oh, okay, well, sorry, same recommendation.
Oh, no. I mean, it brings to the fact that, that book is so important, right? So yeah, which is why I recommend that book a lot also, Psychology of Money. I actually read it. I read it also almost every year, because it's got a lot of wealth of knowledge for sure. And then the third one is a rapid fire. I'll give you 2 options. Let me know which one comes to your mind, right? So stock market or real estate?
Both, but mostly stock market.
And I think I know the answer, but yeah, index funds or individual stocks?
Index funds for sure.
Buying or renting a house?
Doesn't matter, whatever you want to do.
Time or money?
Time or money? Time.
Yeah, the last one, yeah. Health or wealth?
Health. Without health, you got nothing. I know we're all chasing wealth, but man, health is more important.
That's good. Yeah, with that, yeah, Jeremy, thanks for your time. It's been a pleasure to have you on the podcast. How can people learn more about you?
Yeah, so you can find me over on Instagram at Personal Finance Club or on the website personalfinanceclub.com.
Great. I'll link all of them in the description. Great. If you found value in this episode, then please don't forget to subscribe to the Compounding Project. Until next time, trust compounding and take action now. Thank you so much for watching or listening. If you enjoyed this episode, can you do me a quick favor and hit that subscribe button? If you like this episode, then you might enjoy this episode, which links in with some of the stuff we talked today. Thanks for watching. I'll see you next time.